Hello YouTube, welcome back to the channel. It's your boy Michael Honora from Empire Trading, and today we're going to be talking about fundamental analysis and how to trade fundamental analysis like a pro in 2023. As traders, we all know what fundamental analysis is. Fundamental analysis, FA and TA, technical analysis, but we don't actually, majorly, an average trader doesn't actually know how to use this fundamental analysis in long run, because I've gotten questions and requests like, please bro, how do you actually use fundamental analysis? Where do you get it from? How do you apply it to your trading? Do you just put off that? All those questions are going to be answered in this video right now. So get your popcorn and get your drink and have a seat, because it's going to be very educative. And also, do not forget to hit the subscribe button if you're not subscribed to the channel, and also give this video a thumbs up. It's gonna help my algorithm and it's gonna help me go very far. Thank you. So let's head straight. So it's the basic ones you should know is the interest rate, inflation rate, and gross domestic product. These things affect the whole. They can affect the whole economic state of a country, whole economic state or value of a currency very well. So the interest rate, inflation rate, gross domestic product, all these other news events you see, this indicate, I'll call them indicators still, that we see on our economic calendars, are just subordinates or they're just subsets of all these terminologies here: interest rate, inflation rate, and gross domestic. So I'll be breaking and explaining how these things affect and how you can actually use them while trading, right? And use them to enhance your trading. Now, okay, if you normally if we talk about fundamental analysis, the first thing we do here is coming to our forex factory. Yes, searching our forecast for common news events for the coming week and others. Then also introduce you to trading economics. In case of people, you guys that don't know anything about trading economics or how you can use it, this is what I basically use, right, to judge the fundamental analysis, or to have to carry out my fundamental analysis for a given currency or a given country. Right now we have three basically major currency, or let's just use this as an example. Right, we have the USD, which is the United States. We have the GBP, which is the United Kingdom, yeah. You can just England, basically England, right? We also have the euro, right? Euro, yes, as you see, which is the euro area, that's the Italy, France, Spain, Germany, and all, right? But they are all classified as under the euro area, right? These are the two basic currencies we are going to be talking about and how we can judge them, their other counterparts. So if you come to trading economics, so what do I basically do here? I use the indicators. Let's say interest rate, or interest rate, right? Just interest rate, right? Interest rate. So for you, the USD, you can come and use yes, select the United States. Yes, you should know interest rate over time. I change this to line. Yes, you can see how the interest rate has risen over time for the United States, the hike of interest rates causing the DXY to be very strong over the period of time. So if you come to the DXY, say for example DXY right now, right? This is example 1 month. It's taking time to okay. If you can see from the start of this year till the end of last year, it has been very, very bullish. So all this happened not just because of technical. These are fundamentally driven moves. These are fundamentally driven moves. All these moves are fundamentally driven moves. So what caused this? This as a result of what? The rate hike, as you can see here. So now I will be explaining these rates, interest rates, inflation rate, and GDP. Now interest rate, what do you know as interest rate? Interest rate, right, is simply the borrowing costs. Simply means borrowing costs, how much the interest that the central banks are willing to add when lending money out, right? Now interest rates, so how do they come about all this? When interest rates increase, when they hike the interest rate, when the interest rate is high, that means borrowing costs will be very low, creating more demand for that currency, especially that currency in circulation, because there will be high demand of that currency when there is a rate hike. When there is higher borrowing costs, it just makes less supply of that currency, increasing the demand of that currency. When there is an increase in demand of the currency, it as well increases the it as well increases the value of that currency, right, over the long period of time. Now interest rates, you can judge interest rate with other factors like the inflation rate, GDP, and unemployment rate also. As we know, the unemployment rate is the NFP we usually come about. I'm just using the USDA as a case study. The NFP we usually encounter in the market, or that comes out every month, first Friday of every month. That's the unemployment report. The inflation rates, that's CPI, PPI, and consumer. All these things are factors that also affect the rates, either the rate hike, that's tightening monetary policy, or what, loosening the monetary policy, that's the Fed being dovish or hawkish, right? Now for a given currency here, the central bank decides to hike their rates or cut down their rates due to various reasons. They can't just wake up one day and hide their rates. So what are these things? How can we judge a currency, or how can we judge these before even the Fed tried and come out with their reports? How can we do that? Or we can do that with other we can do that using other factors or indicators, like, as I said initially, inflation rate, the GDP, and all. So right now, what is the inflation rate? Inflation rate is just simply the cost of consumer goods price, just simply consumer price hike or increase in consumer price, right? In developed countries, right, we all know, not all shall, but in developed countries, they have a mark of 2% as their inflation target, or 3%. So anything above 3% is hyperinflation. The inflation is going soaring. But anything below 2%, 1, 0, -1, negative inflation rate, that is deflation. And what happens then? When there is a hike in inflation, when there is an increase in inflation, the interest rate, the central bank tends to hike their interest rates to fight down, or to fight this inflation, to try and bring it down to their target, at least to bring it down to their targets, right? And when this deflation happens, or deflation, when it's below the 2% mark, that's -1, 1, 0, they try and cut down their interest rate so that there will be more borrowing costs. There will be less borrowing costs, making that currency to be available, increasing the supply of that currency, so that at least the value could actually appreciate over time, right? So This is how inflation deeply affects how the Fed decides on their interest rates, increasing their interest rate or not. No, you can ask, how is this interest rate, how do I actually need to put this in my trading of something? So it's just basically for having long term targets, right? It's basically for having long term targets and having to hold your position. For example, someone holding a buy position around here, like I'm longing the euro USD because of the increase. I'm shorting the euro USD because the Fed is they're hiking their rates, inflation is going up, they're trying to hike their rates to bring everything down, increasing the strength of the world, of the USD. It helps you know the overall or the long-term buyers of a currency, right? In my previous video above, you can check it out later, I talked about how I wanted DXY, that was in October, to end very bearish, the year ending bearish with DXY. That's October, November, December. How did I judge this? I had technicals by my side, but also finally judged it by the fundamentals. The interest rate report they brought out, it was not they didn't beat the forecast, it was not extraordinary, it was just normal and everything. These are functions and way interest rates can help your trading as well. So I'm going to show you how I use this basically on this website, Traders Economics. I use this on trading economics. So this is the overall interest rate of the USD. You can see 0.25. They maintain the interest rate around there, but look at their first hike by how many basis points? Their first hike, they hiked it by April. I think the first hike was by April, when they hiked it by 25 basis points, 0.5. You can see over as the year progressed, there has just been interest rates hikes. Why? If you check this, if you come back to their inflation rates, you find out that they're hiking this interest rate because of what? An increase in inflation. Inflation rate has been drastically increasing, has been soaring high. I think they hit their all-time high around what month was this? I think this was July or June. I think this was June, yeah, that it hit 9.1 high. So when you have an inflation rate like this, it means the price of goods and services have increased rapidly in the market. So how can they do this? They try and cut this inflation rate by hiking their rate. So it's just like an inverse scenario here, when you kind of, let's say this is the interest, this is the inflation, and this is the interest rate. Interest rate. Now, what happens when the inflation rate is increasing? If the inflation rate, right, is increasing, what happens to the interest rate? The interest rate also increase, so that at some certain point you'll be able to cut down the inflation rate by hiking their interest rate. So that is how you can actually relate these two things. It's just simple. Interest rate, borrowing costs is what you see, the FOMC report. These are all things, the value they bring out from these things. 4.5, what 4.5C, 4.01. These are all interest rate. They do this, they hike interest rate because of an increase in inflation rate. So now judging these things can actually give you an idea of where the markets can progressively move to, or the buyers of the market for a quarter or a year, right? A year is too far, if a quarter or a month rather. So let me use this as a scenario right now, how I personally use this. For example, now if the CPI data for USD, I'm using USD as the base currency right now as example. If the CPI data for the USD is high, it beats the forecast and everything, I should be expecting a hike of the Fed from the next report for hiking their rate, to hike their rate so that they can control this controlling this, right, controlling and hiking their rate to control this simply means USD is going to be strong for the upcoming month or what, upcoming quarter, right? You can see how I've judged my market sentiment or judged my market bias by just this data. But if I find out now that the consumer price are falling, consumer price of goods and services is like the report showed that it fell drastically, I should be expecting a weak dollar, because they are going to try and cut down their rates so that they can what, try and bring this inflation target, or try and bring this inflation to a steady pace, right? So that's how you can basically judge interest rates, inflation rates. And also I didn't talk about the gross domestic product. Gross domestic product is simply the value of goods and services produced in a country, not including the export or anything, just in the country, the value that a country produces, the monetary value of their goods and services that they as a country only produce. So now for you to judge an economic the economic growth or strength of a currency or a country rather, all depends on this thing. If you have interest rates that is not too high, just interest rate just normal, like from 3 to around that range, you are doing very well. But if you have interest rate of 14 point something, like I'm from Nigeria, right, where our economy is very bad, and if you go back and check our interest rate, you can see that our interest rates in Nigeria right now, our interest rate in Nigeria right now is very high. It is very high, very, very high. That's increased borrowing cost. Borrowing cost is very high, so it affects our economy. It affects our economy drastically, right? It affects our economy drastically. So let's just check it right now. Nigeria, I can't actually find Nigeria here. Nigeria as a case study, so I can't actually find Nigeria here still. Okay, Africa. So this is Nigeria. And from Nigeria, I'm using Nigeria as a case study, right? You can see that our inflation rate is 21.0%. You can imagine 21.0%, whereas the ideal target for inflation is supposed to be 2%. So now the best way of our government to cut down this is by hiking their rate to some points of infinity, I guess, because right now, let's say our interest rate currently is 16.5. So this shows that our economy is doing very bad. So these three factors you can actually judge an economic strength of a country by these three factors. Having a stable interest rate or a low interest rate like 1, 2, 3, 4 or less than 10 is good enough. Having inflation rate close to the mark of 2% is good enough, and having a very positive gross domestic product is also good enough for a country. So this is how we use fundamentals to judge your long-term bias. Technical analysis, support and resistance level we'll find on our charts. We're just basically judging or trying to predict the market move by previous historical chart patterns or data. But now adding your fundamentals to this as well, will make you get the bigger picture, will make you see the bigger picture, and also enhance the way you trade and the way you also understand the market, knowing the reasons why market does the things it does. Like for example, you can see here on the DXY, you can see that there was support here, resistance here, but why the market not bounce back from here? Why the market not bounce down from here as a triple top? Why did it break it? It broke it just because of the fundamentals, the strength of the USD. All these fundamentals applies to the market. We can all apply this to our market and make our trading very, very sound, and also have an additional edge in the market. So I hope you guys enjoy this content, and I hope you as well implement this to your trading. So if you have a question, any question, you can drop it down in the comment section below, or if you want me to explain more or go deeper into these concepts, you can also let me know in my comment section. Don't forget to like and subscribe if you're not subscribed to this channel. I'll catch you in the next. Thank you.